All right. Hi, everyone. My name is Mike Jeselchek, CPA over here at Jetron Associates. We're going to get started on this webinar really shortly here, but in the meantime, if you can just let me know, just put in the chat box where you're from, what industry you work in. Just let me know that you can hear me, you can see my screen. You should see a big welcome banner with the webinar. So give me some feedback. Let me know that you're out there. Let me know that you can see me and hear me, and then we're going to get started here within the next couple minutes. Perfect. Got responses coming in already. We got someone from Milwaukee, California, Texas, Denver. It's quite a spread. Another Milwaukee, Wisconsin. Just so everyone knows, our firm here is located in Wisconsin, so we oftentimes on our webinars see a lot of people from Wisconsin on there. Not to mention we work with clients all around the country, so it doesn't necessarily mean that it's always Wisconsin people on there, but that's why we might see some Wisconsin uptick. All right, another Milwaukee, Minnesota, Dallas, San Francisco, Orlando, Green Bay up in the northern Milwaukee. Got someone from California, Santa Barbara, Virginia, Milwaukee, Wisconsin, Oklahoma City, Philly. So it looks like you guys can all hear me well. We have some good insights. Some of the people that are online, their professions. It looks like we got a photographer, a couple of photographers, a couple of realtors, fitness studios, graphic designers, a few startups in there. That's good. This is going to be really good for startups, people just starting out. I have a DJ, a business coach, another consultant. So looks like we are filling up here, guys. So I'm just going to give it one more second to let everyone kind of settle in, and then we're going to go ahead and get started on the webinar. I'm going to turn my video off for the webinar just so that we can focus on the screen here. So, okay, so I'm going to go ahead and get started. So just a couple of heads up, what we're going to be doing is we're going to be talking about a lot of different topics today. We're going to be teaching you how to structure your business to maximize tax savings, how to truly streamline your financials to bulletproof yourself from an IRS audit, how to utilize strong bookkeeping to help your business succeed. And really, that's just the beginning. We'll also be touching on many more topics. If you have any questions as we go along, put them in the chat box and we will address them at the end. So we're going to go relatively quickly on this webinar. So please, if you do have any questions, put them in the chat box. Let me know. We'll address them at the end, and we can always jump on afterwards if we need to. And to start off, let me introduce myself. My name is Mike Jeselchek. I'm a CPA and registered tax planner, as well as the founder over here at Jetron Associates. For the past 10 years, my mission has been to reach tax saving strategies, is to teach the tax saving strategies that are used by super successful business owners to help maximize their profits and avoid getting crushed by the IRS, while also helping you grow your business. So today, I'm going to show you some of those strategies, what I've learned, what we've teach people, what we feel are some of the main things that are useful to you as a business owner. And as we're getting started, I will make this webinar fairly quick so you can get back to work. So because of that, we're going to pack a lot of information into a little bit of shorter time. So before I get into it, I just want to give a fair warning. Everyone's needs are different, and no tax situation is the same. So what we discuss here today will be general tax saving strategies, but it's important that you discuss this with a professional regarding your specific situation prior to implementing any of these actual strategies. And finally, this webinar is definitely not for someone who's trying to defraud the government of taxes. This is not about a tax dodge, a Swiss bank account, or shell corps. What we teach today is leveraging tax laws and loopholes that are naturally built into the system to make sure your business is maximizing every opportunity available to cut your tax liability. So with that being said, let's get started. An IRS audit may be one of the biggest fears for most Americans, and I want to make sure that you are able to avoid that and bulletproof yourself from it happening if it does happen. So I'm going to go through a couple tips on how we can help avoid an IRS audit. First one, open a separate bank account. When you start a new business, it might be easy to just pay for all the startup costs and expenses out of your personal account and then figure it out later when you start making more money. However, this can be sloppy and really cause a lot of confusion and possible misreporting down the road. So as a new business owner, it's vital to open a separate bank account for your business right at the beginning. Even if you are not sure if that business is going to take off, pretend like it is. Imagine that business is going to take off and prepare accordingly. This will allow you to have a clean record of business items and just make sure that there is no commingling of funds with your personal account. Next item, keep great records and receipts. Keeping good records allows you to defend your business expenses. And this is where having a fundamentally strong bookkeeping system really comes into play. While you are keeping a solid record of activity in your bookkeeping system, you should also be saving your receipts. Now, as many of you probably know, I'm a cloud guy. So to me, there's no reason to hold on to actual paper receipts for years when you can simply upload a picture and upload it, or take a picture and upload it online. So there's a lot of software out there that allow you to do that. There's a lot of bookkeeping software that you can actually connect the receipt to an actual payment that runs through your bookkeeping software. But regardless of how you decide to retain your receipts, just be sure that you're keeping them somewhere. And on the receipts, to best support yourself in an audit, write down the major items. Who were you with? What were you doing / discussing? Where were you? When and why and how much? So again, when you're taking a receipt, write right on it the who, the what, the where, the when, the why, and the how much. That will help you remember down the road if you need to, and it also helps support that business expense in the event of an audit. Next item, ditch the cash. Now, I know this might be hard for some industries, but as part of having good records, you want to make sure that you have everything documented with a trail. And for that reason, we tell our clients to avoid cash transactions as much as possible. Cash is hard to track and can really lead to a lot of questions if you were to get audited by the IRS. In the rare event that cash is your only payment option, just be sure to get a receipt so you can properly document that as a business expense. Now, this next item here, verify book income matches 1099-Ks received. If you accept credit cards, your merchant processor will send you a 1099-K at year end. This 1099-K will represent the amount that was processed to your company throughout the year. A copy of this also gets sent to the IRS. Now, the key here is it is important that you verify your income includes all of the items on the 1099-K. Otherwise, if you report income below that 1099-K amount, it would be an immediate red flag to the IRS. Now, you might say, why would I report less than that? Well, there's many reasons that those numbers might not match. Those could include merchant fees, refunds, chargebacks, items like that that get subtracted from the sales prior to being deposited into your bank account. So as an example, you might have a sale for $150, but you only physically receive $142 because the processor subtracted fees out prior to sending it to you. Now that merchant processor is actually reporting $150 to the IRS, not the $142 that it actually sent you. So I'm just mentioning this to be aware of this issue and to make any adjusting entries at year end if you need to true up your account. And finally, file on time. This may sound silly, but just don't file a late tax return. If you need to extend, that is not a problem and oftentimes encouraged. But just make sure that your extension is filed in time along with that actual return then. And if you're operating as an S Corp, be sure to pay yourself a reasonable salary. Now, if you have no clue what I'm talking about, hold tight. We will be talking about S Corps in this later. Also, if you have workers that you hired, make sure you are treating them properly as an employee or independent contractor. And this is what we're going to talk about next. 1 second, I'm just going to grab a quick water here. Okay, independent contractor versus employees. This can really be a topic that many business owners overlook or don't even realize is important. The IRS definition of an employee is anyone who performs services for you, and here's the key part, if you can control what will be done and how it will be done. Now, this is so even when you give the employee freedom of action. What matters is that you have the right to control the details of how the services are performed. Now, like many things with the IRS, that doesn't tell us much. But what we should understand is that the biggest determination between an independent contractor or employee comes down to control. Do you, as the payer, control what will be done and how it will be done? To help illustrate this, I'm going to go through a series of questions that we recently used with a fitness studio client of ours. So just as an example, if you answer yes, or if you as the business owner will traditionally answer yes to these questions, it generally means that you do have control and the worker should be classified as an employee. Does the studio establish the training programs and design the workouts? Do the clients pay the studio, not the trainer, for their sessions? Does the studio determine the price the clients pay? Does the studio set the class times? Does the studio pay for training equipment and the supplies? Do the trainers work under their individual name or a separate business name? And here's another big one. Do you intend for the trainer to work at your studio for a while, not just temporarily work? So, as you can imagine, a typical studio, may answer yes to a lot of those questions. However, there are a few characteristics of an independent contractor that are key to note. Independent contractors generally someone where the worker has their own business and they perform services for many other businesses. They design their own training programs outside of the studio's control. They determine their own schedule. They determine their own pricing. They bring their own clients in. They provide their own equipment. So what I typically tell clients is that after reading the facts and going through the questions, you feel that your workers should be classified as independent contractors, definitely take advantage of that and pay them that way. If, however, you believe that your workers should be employees, but you instead choose to treat them as independent contractors, just consider the risks that you are taking and maybe rethink your options. So again, if you think they're independent contractors, by all means, go ahead and treat them that way. Now, I often get people that say, well, my friend who owns a business does it this way, or I'm just going to fly under the radar, or the worker requested to be an independent contractor. In my response to those clients is that just because one business does it one way does not mean it's correct. Their answers to those questions may be completely different, or maybe they're just hoping to not get caught. You might think you can fly under the radar, but you are actually not just going up against the IRS in these cases, but also the state. And as your business grows, the potential penalties, fees, fines, back taxes will just continue to snowball and add up. And finally, if the worker requested to be an independent contractor, that doesn't necessarily make it okay. If you happen to get audited and the worker is supposed to actually be an employee, you are the one that's stuck holding the bag, not that actual worker. So just some things to keep in mind there. All right, designing a bookkeeping. This is what I call one of the most important topics for today. Having a solid bookkeeping system should be the number one thing on every small business owner's checklist. There are so many benefits that's not worth losing out on not keeping a good bookkeeping system. The first thing I recommend is utilizing cloud technology. We are in the 90s now, so upgrade your accounting system to the cloud. Our favorite cloud bookkeeping software is Xero, but there are many others out there, including QuickBooks Online. But not only does moving to the cloud give you access to your financial data at any time, anywhere, it also allows for easy collaboration with your accountant or any other party that may need access to your books. So you'll never need to worry about backing up a file or making sure you have the right computer with you. Another thing about the cloud accounting software is that it's easy to integrate with other applications. So you could, if there's a feature that the software might not have, there's lots of integration among accounting softwares online. Next, it's vital to keep your books current. Having a good bookkeeping system is not just important for tax time, but it can be important to help you run your business more effectively throughout the year. The key part here is that your bookkeeping has to be up to date. We recommend doing your bookkeeping on a monthly basis to avoid getting too far behind. And if you leave your bookkeeping sit with no activity, it's really not useful. So this is a key part to this. If you are going to do bookkeeping, be sure to just do it accurate. Set time out every week to do that. Finally, plan for expenses and taxes. As you are doing that monthly bookkeeping, be sure to plan for future expenses and taxes. Create budgets and projections so that you can better understand your business's cash flow to plan for the future. Since you are also self-employed, it's important to understand now that you are responsible for paying the IRS and state taxes, not someone else. So when you're doing those budgets and projections, factor in cash that will need to be used to pay for your personal taxes. All right, onto the tax portion of the webinar. The number one mistake that we see business owners make on the tax side is failing to plan. Now, I don't care how good you are or your tax preparer is with a stack of receipts in April, but if you didn't know you could hire your kids or implement some other tax planning strategy, there's nothing we can do at that time. Tax planning is about giving you a plan to minimize your taxes. What should you do? When should you do it? And how should you do it? And really, tax planning gives you two more powerful advantages. First, it's the key to your financial defenses. As a business owner, you have two ways to put cash in your pocket. Financial offense is making more money. Financial defense is spending less. And for most of us on this webinar today, taxes are our biggest expense. So it really makes sense to focus our financial defense where we spend the most, which is taxes. Second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business, but that can't guarantee results. Or you can organize your company correctly, hire your kids, and implement many other strategies and guarantee those tax savings. All right, so here's the bottom line and most important thing to understand. You lose every time you spend after-tax dollars that could have been pre-tax dollars. So let me repeat that. You lose every time you spend after-tax dollars that could have been pre-tax dollars. So with that being said, there are four main buckets or strategies that you can use to cut your tax bill. A timing-based strategy, like using a 401k deferral to shift today's tax bill to tomorrow. Income shifting strategies to move taxable income to lower bracket taxpayers, like your children. Code-based strategies, like a Section 105B. They may let you deduct your family's medical bills as a business expense. And product-based strategies, like separately managed accounts and insurance. Now, one huge mistake is also choosing the wrong business entity. Most business owners start as a sole proprietor and then they grow, establish an LLC or a corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners are operating with entities that may have been appropriate when they were first established, but just don't work as effectively as they do now. All right, so let's start with the main problem we are looking to solve. This nasty thing called self-employment tax. If you operate your business as a sole proprietorship or a single member LLC, taxed as a sole proprietorship, you will report the business net income on a Schedule C. The net income is subject to income tax at whatever your regular income tax rate is, but you'll also pay self-employment tax at a rate of 15.3%. This nasty self-employment tax is the combination of Social Security and Medicare, which you might also know as FICA taxes. As a sole proprietor or single member LLC, you have to pay self-employment taxes on 100% of your profit. As an example, a business profiting $80,000 per year would pay regular income tax rate, a regular income tax at whatever that rate might be, as well as self-employment tax on 100% of that profit, which would, in this case, on $80,000, would be over $11,000 in self-employment tax. And one thing to note, this is unavoidable in almost every way. There are no deductions. There are no credits. It doesn't even matter how many kids you have. This tax is coming at you if you make this money. Now, fortunately, there's a way to help limit this self-employment tax, and that's what brings us to our number one tax saving strategy that we recommend to over 90% of our clients, the S Corporation. The S Corporation can be an LLC or C Corp. It does not change how you're organized at the state level. It is simply a tax election. So let me repeat that. An LLC or an S Corp can be an LLC or a C Corp. They remain that same entity. It's just a tax election that we make. The S Corporation divides the business profit or earnings into two parts, a salary and a dividend. You need to take, as an S Corp owner, a reasonable salary, and this is the part that is subject to self-employment tax. However, the rest of your earnings you are able to take in the form of distributions or dividends, which, as crazy it sounds, are not subject to self-employment tax. There is simply a law where S Corps do not have to pay self-employment tax on their distributions or dividends. So you will get a W-2 for your salary amount just like any other employee. The rest of the dividend portion you would simply take as a transfer to your personal bank account just as you do now. Again, you'll pay regular income tax on both halves, the salary and the dividend, just like you did with that sole proprietor or single member LLC. You'll pay self-employment tax in the form of FICA withholdings on the amount you take as a salary only. It's the same 15.3% that you paid as a sole proprietor. But again, here's where the magic happens. You'll avoid self-employment tax entirely on the amount that passes through to you as a dividend. So I want to run through some examples so you can see the tax savings, kind of see this actually play out. A minute ago, we looked at a business owner earning $80,000 as a sole proprietor. They were paying over $11,000 in self-employment tax. This is on the left side here. Now let's imagine we take that same business and have it taxed as an S corporation. While doing that, you decide to pay yourself a salary of $36,000, taking the remaining $44,000 as a dividend. In that scenario, you would save almost $5,800 in self-employment tax alone. This is especially valuable because we're simply eliminating a tax. We're not asking you to put $5,000 into a retirement plan and then deduct it, or take, $5,000, buy new equipment and then deduct it. We are simply avoiding that $5,796 in self-employment tax. It's also important to note that this is not just a one-time tax savings. This is a savings that you will see each and every year. Now you may be saying, but Mike, I am new, or I'm just getting started, or I'm too small. And I get this all the time. But here's the cool thing. We typically say that as long as you plan to profit $10,000 or $15,000 or more, there are tax savings still available to you. On the screen now, you'll see an example of someone profiting just $15,000. In that scenario, let's say you take a $1,000 salary and the remaining amount as a dividend. On just $15,000 in income, you would see tax savings of almost $2,000. And again, this is not just for this year, but it's for every single year thereafter. The savings using the S Corp are real and should not be overlooked by a business, regardless of your size. So if you're a bigger business and plan to profit 6 or 7 digits, the tax savings will always be there and available. Very rarely would an S Corp not make sense for a small business. Now, there are some states, like Tennessee, for example, where special attention needs to be given to see if the tax savings still make sense, but it's a rare situation. The tax savings from an S Corp generally makes sense for the majority of business owners. And remember, guys, this is not just a one-time tax savings. This is something that we can implement and see year after year. Now, let's look at the fine print a little bit more, because I already know what you're thinking. Well, Mike, why not pay zero salary or a ridiculously low amount like $1,000 a year salary? Well, the rules require you to pay yourself a reasonable salary for the work you do as an employee for the company. Unfortunately, the IRS doesn't tell us what's reasonable, and it's not always easy to determine. So the IRS and tax court that we see through code look at several factors when there's a dispute over reasonable compensation. These are the nature of the business, the employee's qualifications, responsibilities, and time that they put into the business, the owner's compensation compared with non-owner compensation, and the amounts that businesses would pay for a comparable type of service from somebody else. Now, every year the IRS publishes spreadsheets reporting all sorts of mind-numbing stats, but included in this is the average amount of salary that S corporation owners in aggregate pay in the form of officer compensation versus the amount they take as income dividends. Previously, that percentage was 32%. Now, I'm absolutely not suggesting you take that percentage as any sort of guideline or safe harbor. However, I do want you to see that using the S Corp to minimize employment tax is a well-established mainstream planning strategy. There are companies out there that can help determine a reasonable salary if that is needed. Also, here at Jetro, we have a matrix that we use to help determine what we believe is a reasonable salary for you as well. So it's not just a guessing game. We do have some background about what we think is a reasonable salary. All right, so let's cover some of the nuts and bolts of an S Corp. First, you, again, need to have either an LLC or a corporation set up with your state. Then you get an employer identification number, and then you file the actual S Corp election, which you will make on Form 2553. So getting set up as an S Corp is fairly straightforward. You just kind of file, you register, get an EIN, file for the election. Once your S Corp is official, you'll have some ongoing paperwork requirements. You'll need to start filing those payroll returns. So as you're running payroll, you'll need to file the payroll returns, the taxes involved with it, and things like that. If you already have employees, not a big deal. You'll also need to manage state unemployment and workers' comp premiums and adjust your own estimated taxes to reflect these amounts that you'll now be taking as a paycheck. At the end of the year, you'll have to file the payroll forms, the W-2, W-3, along with federal unemployment. And here's the big thing. You'll also have to file a business tax return with the IRS and state. Now, this business tax return will flow through to your personal return, but it still has to be done as a separate return. So when I tell clients, what are the pains of going with an S Corp? I tell them two things. First, you have to run payroll. Second, you have to file a business tax return. Other than that, if you can get past those two items, it makes complete sense. Now, on to retirement. If you're looking to save more than the $5,500 limit for IRAs, you have really three main choices: simplified employee pensions, or SEPs, simple IRAs, or 401ks. Now, I'm not here to make you an expert on retirement plans, but what I do want to explain is the SEP a little bit further because it's a very powerful strategy. The SEP is the easiest plan to set up simply because it's a turbocharged IRA. If you are self-employed, you can contribute up to 25% of your net self-employment income. That amount does not include the SEP contribution itself, which means you can actually contribute about 20%. If your business is incorporated and you are salaried, you can contribute 25% of your covered compensation, which is roughly that salary amount. The maximum contribution in 2018 is $55,000. Now here's the big thing. If you got employees, you'll have to contribute for them too. You generally have to contribute the same percentage for your employees as you do for yourself. However, you can use what's called an integrated formula to make extra contributions for higher incomes. This money goes straight into an employee IRA account. There's no annual administrative or paperwork required. The SEP is easy to adopt, easy to maintain, and fairly flexible. If there's no money to contribute, you just don't contribute that year. The contribution is still limited to a percentage of your income. So if you set up an S corporation to limit that self-employment tax that we just mentioned, you might also be limiting some of your SEP because, again, it's only allowed 25% of your income there. Okay, now let's talk about another tax saving opportunity: family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting that tax to someone who pays less. Now, yes, there's a minimum age. For now, at least, they have to be at least 7 years old, traditionally. Their first $12,000 of earned income in 2018 is taxed at zero. And that's because it's the standard deduction for a single taxpayer, even if you claim them as your dependent. So you can shift a lot of income downstream. Again, their first $12,000 of earned income, everyone's first $12,000 of earned income in 2018 is taxed at zero. Now, you do have to pay them a reasonable wage for the service that they perform, and the tax court says a reasonable wage is what you'd pay a commercial vendor for the same service, with an adjustment made for age and experience if needed. So as an example, if your 12-year-old son cuts grass for your rental properties, pay him what a landscaping service might charge. If your 15-year-old keeps your books, pay them roughly what a bookkeeping service might charge. To help audit-proof your return, make sure you write out a job description and keep a timesheet for them, and you pay them by check or digitally so you can actually document the payment. Again, try to avoid cash. Now, you must deposit the payment into an account in the child's name, but it doesn't have to be your child's pizza Nintendo fund. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college savings plan, or it can be a custodial account that you control until they turn a certain age. Now, you can't use money in a custodial account for your obligations as a parent, but private schools aren't obligations of parental support. Sleepaway summer camp isn't an obligation of parental support. So let's say your teenage daughter wants to spend 2 weeks at horse camp. You can earn the fee yourself as a parent, pay the tax on it, and pay for the camp with after-tax dollars. Or you can pay her to work in your business, deposit the check in her custodial account, and then, as custodian, pay for the camp. Hiring your daughter in that scenario effectively lets you deduct her camp as a business expense. If you hire your child in an unincorporated business, you do not have to withhold for Social Security until they turn 18. So this really is tax-free money. If you'll have to issue them a W-2 at the end of the year, but this is painless really compared to the tax that you'll waste if you don't take advantage of the strategy. Okay, so now, unless you live on a rock, you probably have heard about the new tax law, the Tax Cut and Jobs Act. I don't want to dig too deep into this new tax plan. That could be a webinar or a whole series of webinars. However, I do want to hit some very high-level, quick-hit items. For business owners, the Section 199A deduction is an important thing to know about. In a nutshell, the Section 199A pass-through entity deduction gives the owners of pass-through businesses, and this includes sole proprietors, partnerships, S corporations, it gives them a deduction equal to 20% of qualified business income. So as an example, if you are an S corporation shareholder earning $100,000 from the company, you will get a $20,000 deduction, paying income on bringing your income level to $80,000. Now, if you're a single with taxable income of $157,000 or more, or you're married with taxable income of $315,000 or more, things do get a little bit more complex. So I just recommend that you research that a little bit deeper. There's probably not too many people on here that are set up as C corporations, but if you are, the corporate rate is now down to a simple flat 21%. Entertainment expenses. Here's a change you probably won't like. Under the old rules, you could deduct 50% of the cost of business-related entertainment expenses. Deductions included the face value of tickets to sporting events, theater events, food, beverages, parking, taxes, tips, etc. The new law repeals that deduction. So regardless of what business entity you operate as, C Corp, S Corp, sole proprietor, business entertainment is no longer deductible. Business meals are still deductible 50%, just no entertainment cost. Bonus depreciation. With the new law, businesses can claim 100% bonus depreciation for qualified property. Generally, qualified property means anything except real estate and land improvements, and this can apply to both new and used property. And not net operating loss here at the bottom. In an ideal world, your business would make money year after year, and lots of it. But we don't always live in an ideal world, and sometimes businesses lose money. So if your business spends more money than it makes in a year, that's called a net operating loss. And while nobody wants to lose money, a net operating loss doesn't just get wasted. It can help you save tax in a different year. The new law makes 3 changes to the net operating loss rules. 1, it eliminates the 2-year carryback period previously allowed. So if you had a net operating loss in 2018, you used to be able to carry it back 2 years. It eliminates that. It lets unused net operating losses be carried forward indefinitely. These used to only be able to be carried forward 20 years. And finally, it limits the net operating loss deduction for future years to 80% of that year's taxable income. All right, so we've covered a bunch of different topics in today's webinar, and for most of them, we are really just kind of scratching the surface. Some of the biggest takeaways I want you as a business owner to retain from today's webinar are: start tax planning now so that you can utilize these various strategies available to you and your business so you can save thousands not only this year, but each and every year. Next, develop and maintain a solid bookkeeping system. This will be the core of your business success and will help bulletproof yourself from an IRS audit, as well as just simply make tax season a breeze. It will also help grow your business and assist you in understanding of how your business is performing and where you can improve. If you missed any of the items we discussed or want to hear them again, there will be a recording of this, so definitely take some time to go through those items that are important to you and your business. Now, before we get to questions, and again, please send questions in as we go along here, I want to run through some of our services with you so you can understand how affordable this really can be. We have 2 types of packages. Our core package, which is for businesses under $1 million in revenue in a year generally, and our advanced package, which is more customized for those larger businesses. For now, we're just going to focus on our core packages, but if you have over $1 million in revenue, hit me up privately and we can discuss. Our core packages are priced based on annual gross revenue, and as you can see, they are extremely affordable. In almost every case, our core package our core package price more than covers the tax savings we can provide from the S Corp conversation. The services the services that are included in our core packages are what we believe every business owner needs at an absolute minimum. So our core package includes monthly bookkeeping. It also includes the business tax return, the preparation, filing, as well as the digital copies. It includes monthly financial statements, which we'll send over to you on a monthly basis. It also includes limited communication with our staff and a full review twice a year. So again, this is the core packages. This is what we believe is the starting point, what every business owner needs at an absolute minimum. Now, we also offer add-ons that aren't required but may be very useful to have as a small business owner. Some of our favorites here, and I have the add-ons listed here. Some of our favorites are unlimited support, tax planning, zero subscription. But that's really up to you. These are the items that we feel we make available to our clients. We used to have our core package, or we used to have 3 packages, and small, medium, large. Everyone fell in the medium, which caused them to be forced on services that they didn't need potentially. And it also caused them to jump up a package when they only wanted one additional service. So what we've did now, we've moved to our core package and then added add-ons to go from there. So once you are ready to begin with our firm, we simply send over a service agreement digitally. You pick your gross revenue and the add-ons you're interested in, and we get started right away. Our onboarding process is very comprehensive and really ensures that you have the best start with our firm. All right, so to put this in perspective, earlier we talked about someone profiting $80,000 on $100,000 in revenue. Now, our price for that would be $125 per month or $1,500 for the year. The tax savings that we would be bringing to that client would be almost $5,800, and this is just bringing the example that we used earlier. So that means that they not only paid for our services, which include the bookkeeping and the business tax return, with those tax savings, but they've also put a ton more money in their pocket and after those tax savings. So even with an example of someone profiting $15,000 per year, our fee is $75 per month or $900 per year. And we bring them almost $2,000 in tax savings. So it honestly doesn't make sense not to work with us, not to implement this strategy, not to become an S corporation. As long as you're hitting, again, that $10,000 to $15,000 in profit or more, this simply makes sense. Now, since you've decided to join us on today's webinar, we are offering an exclusive deal. The first month will be absolutely free to you. Now, I don't do this too often, but there are so many business owners out there that are honestly dying for these tax savings, and I want to be able to bring them to you now. So you can simply reply here or shoot me an email that says I'm ready, and I will send you our digital service agreement to get started with that first month free. The longer you wait to get started on this, the more time passes that you are paying more in that self-employment tax than is absolutely necessary. So what I'm going to do now is I'm going to break this down and go into some questions that the attendees had. Okay, so the first one is here, Andrew. He says, I take a client golfing to try and close a deal. That is still deductible, right? Unfortunately, no. So that is part of that entertainment expense that got cut off. Taking a client out to dinner, to lunch, to entertaining a client is no longer tax deductible. Nick, is there a software you recommend for bookkeeping and payroll? Yes. So we recommend a software called Xero for bookkeeping and a software called Gusto for payroll. Those are the softwares we use internally for our clients. Jason, is there a situation you don't recommend an S Corp for? This is an interesting question, Jason, because there are some times when S Corp does not make sense. Generally, that's because if they have international owners, they're not allowed to be an S corporation. So if you have international owners, Canada, Mexico, can't be an S corp. There is a workaround about that. So if you are in a situation like that, let me know. Sometimes there's state restrictions, kind of as we mentioned before. If you're in Tennessee, there are some states that have restrictions. Doesn't quite make sense. Hobby businesses. If you're not profiting a certain amount of money, again, it might not make sense to do that S corp. Let me see here. See if there's any other questions. All right, so I did put some information up here. If you're looking for more information on this or are interested in how I can help you out further with your accounting, bookkeeping, tax planning, tax preparation, payroll, etc., do not hesitate to reach out to us. You can catch our website there. It's jetrotax.com. You can also email me directly at mjezoshek@jetrotax.com. If you already get started and get your business on track right away, you can also book a call. If you have more questions for me, you can use my Calendly link there. It's calendly.com/mjezoshek. Either way, I just hope I was able to help you out and start to get some gears moving in the right direction so that you could be on your way to tax savings and that business success. So I just want to say, everyone that's on here, thanks for jumping on today. I will be staying on a bit longer for any questions that may pop through, and I do see one here. So if you do have questions, feel free to keep sending them. Caitlin said, what states do you operate in? So our company is headquartered here in Wisconsin. We operate in all 50 states. We have clients across the country. We also have employees scattered around the country. So we do operate across state lines. Jason said, when is it too late to do an S corporation? So the big thing with the S corporation, you have to have an entity set up. So if you start, let's say, an LLC on January 1st, we can do a late election in October or during tax season next year. But if you don't have that LLC set up, we can't do any kind of late election. We can't take pre-LLC earnings and expenses and business activity and move it into a post-LLC, if that makes sense. So when is it too late to do an S corp? I would do it now, especially for 2018 here. If you want to take advantage of it to 2018, I would do it now. If you want to take advantage of it starting 2019, you can do that. I would get set up and put that election through early January. Tanya said, what do I need to write on receipts to back up an expense? So Tanya, the biggest things to write on receipts: the who, the what, the where, the when, the why. Again, just write as much information on that receipt as possible, because in the event of an audit, you're going to have that receipt, which will back it up. But if you get audited a year and a half down the road, you might not know what that was for. So put as much information that can help both you and the auditor know exactly what that was for. Okay, so if there's any other questions, let me know. If not, that's all I'm saying. Again, I'll hang on for a minute or two, but I just want, again, thank everyone for jumping on, and I hope to kind of work with you guys in the future.